The market is not a machine to be solved, but a conversation to be understood. Good morning. I want to start with a question that has puzzled traders for decades. Why does Fibonacci work in financial markets? Today, I'm going to share with you the 3 fundamental principles that finally unlock this mystery for me. By the end of this talk, you'll understand why millions of traders worldwide swear by these ancient mathematical ratios, and more importantly, you'll see markets in a completely new light. The 3 pillars of market understanding. Pillar 1. The non-linear nature of price movement. Take a look at any currency chart right now. What do you see? Candles of different sizes, shapes, and colors dancing across your screen. Here's the crucial insight. These movements are fundamentally non-linear. What does this mean? It means there's no mathematical formula, no equation, no algorithm, that can fully capture and predict these price movements. Think about it. If there were such a formula, wouldn't someone have already solved the market by now? This nonlinearity is both the market's greatest challenge and its most fascinating characteristic. Every spike, every dip, every sideways movement represents thousands of human decisions, emotions, and reactions happening in real time. We're not dealing with physics here. We're dealing with psychology at scale. Pillar 2. The power of chart levels. Here's where it gets interesting. Despite all this chaos, price tends to reverse at certain levels. It's that simple, yet that profound. The question becomes, how do we identify these magical turning points? The answer lies in what I call chart levels, what most traders know as support and resistance. These levels tell a story. They show us where price has previously reversed, where buyers stepped in, where sellers took control. When price approaches these levels, it can do one of 3 things. 1. Bounce off the level, like hitting the floor or ceiling. 2. Break through the level, like a dam bursting. 3. Hover around the level, like a bird deciding which way to fly. Understanding this behavior is like having a conversation with the market itself. The levels are the market's way of communicating its intentions. Pillar 3. The universal language of price. Here's something remarkable. Whether a trade is placed by a sophisticated AI algorithm, a Wall Street trading bot, or someone on their phone during lunch break, the process is always the same. Every trade, everywhere in the world, follows this simple structure. An entry at a price level. A stop at a price level. A target price at a level. It doesn't matter if you're trading Bitcoin in Tokyo or gold in London. This universal language of price connects every market participant across the globe. The Fibonacci revelation. Now, let me tie this all together and reveal the truth about Fibonacci levels. Fibonacci levels are not magical numbers floating in the cosmic consciousness of the market. They're not some mystical force that guides price movements. Here's what they actually are. When you apply Fibonacci retracement to a chart, you're taking a scale from 0 to 100 and dividing it into 5 nonlinear levels: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. But here's the key insight. You're applying these nonlinear ratios to nonlinear price movements. What you're really doing is creating 5 nonlinear placed levels across the chaos of nonlinear price action. These levels work not because of ancient mathematical magic, but because they provide structure to the nonlinear movements we discussed earlier. Think of it this way: if you randomly threw 5 darts at a dartboard, some would be closer to the bullseye than others. Fibonacci levels work similarly. They give you 5 nonlinear placed darts across the price movement, and naturally, price will interact with some of them. The practical truth. This is why experienced traders speak so highly of Fibonacci levels. Not because they're mystical, but because they provide a systematic way to identify potential reversal points in an otherwise chaotic, nonlinear system. I use Fibonacci levels in my trading, and now you understand why they work. They're not fortune-telling tools, they're probability enhancers. They help us navigate the 3 pillars we discussed: the nonlinear nature of price, the power of chart levels, and the universal language of trading. Closing thoughts. The next time you look at a chart, remember this: you're not looking at random price movements. You're looking at the collective psychology of millions of market participants, expressed through nonlinear price action, interacting with key levels, all following the same basic principles of risk and reward. Fibonacci levels work because they provide structure to chaos, turning the impossible task of predicting nonlinear movements into the manageable task of identifying probable interaction points. The mystery isn't in the numbers, it's in understanding the human behavior that drives the markets. And that, my friends, is the real secret behind why Fibonacci works. Thank you.